That's a signal of the public finally waking up, right? The banks wake up, the financial players who see a little bit deeper what's going on in the derivative system, they make their moves in gold before the public finally wakes up. What makes the public wake up? Well, not the derivative markets, the supermarkets. That's what makes them wake up. Then they go for silver. So we're going to see that at the very, very end. Where silver is going to go in the very, very end, of that cycle, in the hundreds, maybe even the thousands. I don't know. It depends. These numbers don't really mean anything when the dollar doesn't buy anything. So, I mean, it's anyone's guess, but I do think that the ratio, at least briefly, will fall to 15-1, which is what I'm waiting for. And when that happens, I'm just going to buy a bunch of stuff with silver, and whatever I can't buy, I'll just convert back into gold.
Financial journalist Rafi Farber highlights the surprising resilience of gold, which has maintained its upward momentum in recent months without significant corrections. While he remains cautious and prepared for potential declines of $50, $60, or even $100, he notes that silver is finally breaking free from a prolonged period of stagnation, currently trading above $34. Historically, silver tends to lag behind gold during bull markets, a trend observed in the late 1970s and from 2008 to 2011, when silver ultimately surged after an initial lackluster performance. As market conditions shift, there is growing anticipation about silver's potential reaction. A critical factor contributing to silver's potential rise is its significant demand in military and aerospace applications, an area that has received less attention compared to its roles in consumer electronics and renewable energy. Recent analyses indicate that military demand for silver may surpass that of other sectors, raising important questions about the transparency of silver demand data. This hidden demand could set the stage for a dramatic price increase as the market begins to recognize silver's true value. The precious metals market is currently experiencing notable shifts, particularly with gold's impressive performance and the unusually high short positions held by bullish banks. This combination fosters a sense of cautious optimism among traders, reminiscent of the gold rally from 2008 to 2011, during which prices continued to rise despite substantial short selling. Traders are closely monitoring these developments, understanding that if gold maintains its upward trajectory, it could lead to significant price movements in both gold and silver. The tension created by these high short positions could increase volatility, presenting opportunities for traders to profit from sudden price fluctuations. Simultaneously, interest in silver as an investment is growing amid rising inflation and declining dollar purchasing power. Analysts suggest that silver could experience substantial price increases, potentially reaching hundreds or even thousands of dollars per ounce. Now, let's present clips of Rafi Farber's insights from his recent interview. Before we continue, please subscribe to our channel and activate the bell icon for timely updates.
What's surprising to me is that gold hasn't had much of a correction for how long has it been? I don't even know. It's been months. On the one hand, like, I'm emotionally ready for a correction. Like, if gold were to go down 50, 60, 70, even $100 in some kind of like little crunch, it wouldn't surprise me, but it's not happening. And I looked at the commitment of traders in gold, right? And the worrying thing is that the bullion bank short positions are very near a record high in gold. But what I also noticed is that you go back all the way to 2008, 2009 to 2011, the strongest portion of the gold bull market of that era was after the 2008 crash, right? And then gold goes something from like 642 to 1923. What was it? From October 2008 to September 2000. So about 3 years. It goes from more than triples, about triples. And in those 3 years, the COTs, the commitment of traders, who's positioned what in the futures market, if you trust those numbers, I don't completely trust them, but I think they're basically accurate, maybe. They look very similar to now. And for most of those 3 years, the bullion bank shorts were at or near records for 3 years. So I'm saying, like, yeah, we're in a dangerous position where you could get people knocked out especially if they're in leverage or doing some kind of crazy trading strategy with options, which I never ever recommend. But those people could get kicked out if they're just trend followers or if they're hedge funds or something. But then again, we could be I mean, we had 3 years of this from 2008 to 2011, so we could have that again, and we could just keep going higher from here, just like we did in those years. I'm not going to try to play it. With silver, silver didn't really make a move until 2010, 2011. So 2008, 2009 didn't do that much. Same thing in the 1970s, like from 1975 to 1979, silver did basically nothing. And then all of a sudden, 1970 to 1980, the last half of 1979 into the first 3 weeks of 1980, silver just goes crazy. So that's a signal of the public finally waking up, right? The banks wake up, the financial players who see a little bit deeper what's going on in the derivative system, they make their moves in gold before the public finally wakes up. What makes the public wake up? Well, not the derivative markets, the supermarkets. That's what makes them wake up. Then they go for silver. So we're going to see that at the very, very end, where silver is going to go in the very, very end, of that cycle, in the hundreds, maybe even the thousands. I don't know. It depends. These numbers don't really mean anything when the dollar doesn't buy anything. So I mean, it's anyone's guess, but I do think that the ratio, at least briefly, will fall to 15-1, which is what I'm waiting for. And when that happens, I'm just going to buy a bunch of stuff with silver, and whatever I can't buy, I'll just convert back into gold.
Recent discussions among financial analysts have raised alarms about the implications of reverse repos potentially returning to zero, a scenario not witnessed for most of the past decade. The reverse repo facility has declined as the Federal Reserve unwinds pandemic-era stimulus by allowing Treasury and mortgage securities to expire without replacement. This has resulted in a reduction of the Fed's overall holdings from approximately $9 trillion in mid-2022 to around $7.1 trillion. Most of this balance sheet reduction has been financed by cash, leaving the reverse repo facility in search of more attractive rates in the private market. After experiencing almost no inflows at the beginning of 2021, the facility peaked at just over $2.6 trillion by the end of 2022. Rafi emphasizes that our economy primarily operates on debt rather than tangible assets like gold. In an inflationary environment, a contraction in credit could trigger defaults and financial instability. The recent rise in short positions on Treasury securities raises concerns about a potential liquidity crisis, which could lead to rapid asset liquidation, particularly in the real estate market. As reverse repos decline, the excess liquidity supporting the economy may soon disappear, raising speculation about the Federal Reserve's next moves. Now, let's return to the interview.
It's inherent in what credit really is, or how the Keynesian inflationary fueled economy works, right? We're not really a money-based economy. We're a credit-based economy, and credit is issued, and that's how businesses work, and it's how international businesses work, and there's just circuits of credit with people trusting each other, and the actual money that's supporting it all is very, very low, very, very small amount. And if you look at the Fed's balance sheet, the amount of gold is like 8%, and the rest is just debt, which is credit. And debt and credit are the same thing. They're two sides of the same coin. If the credit supply can't shrink, and it cannot shrink in an inflationary system, then debt can never really default. Because if it defaults, or it's paid back and it's extinguished, or it can never really be extinguished, then the business cycle turns, you get a bust, they get the bank crises, because banks don't lend money, they lend credit these days. So what really happened from about World War II until 2008, the credit supply gently increased. The Fed had pretty much control within larger cycles of the monetary system, and the circuits of credit kept going. But in 2008, they all kind of fell at the same time. Then you had all of this bad credit or bad debt, which is really the same thing. And the Fed had to buy it all, put it on his balance sheet in order to keep the banking system going with the fuel that it had been on for the previous decades. And now you have all these bank reserves, right? They bought the bad credit, and they bought it with dollars, right? They said, "Here, give me the bad debt or the bad credit, whatever you want to call it, and we'll give you these dollars, and you can put them in the basement." And that's bank reserves. But banks can't just sit on reserves. Every bank competes with every other bank, so they have to earn interest on these things. So they either put them in the derivatives market, or wherever they fit to earn some kind of interest, or they put them back in treasury paper, wherever it is that can earn interest, right? And now there are so many reserves that they don't even fit in the system, because there weren't enough. It seems like a crazy statement, but there weren't enough treasury bills for all the dollars in the system. And since they couldn't buy treasury bills, then it would cost them money to hold it. So the Fed said, give it back to us and we'll give you interest as if you were buying treasury bills. And that's a reverse repo. The banks give, the Fed, the banks give the Fed cash, the cash give the banks treasury paper. So it's basically a treasury bill, just a treasury bill that doesn't exist because there's not enough. All right. So the thing is, now the banks are used to having all these reserves. They've put them places different. They've tucked them away, like under mattresses and under this like scary mattresses, not like a mattress that you sleep on, obviously, but like scary derivative mattresses where they have all these reserves. And now all the trades that they've held there are dependent on these reserves continually funding those trades. When the reversed repos run out, that means there's no more excess liquidity that couldn't be sopped up by treasury bills, and then reserves start to fall as they get used up. And there's some point in there where things start to unwind. And that's the point where the Fed's going to have to go in again. Exactly what they're going to have to do, I don't know. But last time they went back into repos and there were like $500 billion in repos offered the next few months, something like that. But the balance sheet's going to expand. And then the question is, what is it going to spill into? Last time it spilled into some kind of disease out of China. Let's not speak of it. If that was connected or not, we don't know. And I'm not going to make any claims here, but could have been. We'll see what happens this time, but it's going to be the same story, just like twice as big.
Silver is currently experiencing a consolidation phase after recently reaching a high of $34.87. It has found support at the 38.2% Fibonacci retracement level of $33.09. If silver breaks above last Friday's high of $34.02, we could witness the emergence of a bullish trend that might drive prices higher. The combination of a weaker US dollar and lower treasury yields is enhancing silver's appeal to international investors, making it a more attractive option. These favorable conditions could lead to rising prices, particularly as market participants look for safe haven assets. Looking ahead, important economic reports, such as Q3 GDP data and employment changes, are on the horizon and could significantly affect market sentiment and silver prices. Additionally, China's upcoming parliamentary session may introduce economic stimulus measures that could further influence global stability and create upward pressure on silver prices. We'd love to hear your thoughts on Rafi's analysis in the comments below. Don't forget to like this video, subscribe to the channel, and turn on post notifications for more content like this. Thank you for watching.